Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Christopher A. Paniotu, certified financial planning professional, the Cap in Capitalize. And on today's episode, I'm going to get into 8 year-end stock strategies for retirement savers. But not only am I going to do that, I'm going to give you the 8 most popular, and then I'm going to give you my opinion on if they are valid or not. But as always, before we get into the meat of the episode, the free advice for the week. When in doubt, avoid getting fancy with your money. Who cares if you've made your money simplistically? The fact is, you've made money and you have money. So when in doubt, keep it simple. Now that we've got that free advice out of the way, it is time to get into the 8 year-end stock strategies for retirement savers. And I wanted to set the stage appropriately for this episode because retirement has obviously changed drastically over the last couple of generations. And the traditional idea of retirement in the United States, it up until recently, and recently is kind of a liberal term, but it's leaned on what was known as the 3-legged stool metaphor. And that means that the typical American expected to rely on pension income, Social Security income, and private savings to fund their retirement lifestyle. And really an emphasis on those first two. The reality for most of you is retirement today and going forward, it's going to look a lot different because pensions, for all practical purposes, are gone. Yes, if you work for selective private companies, if you're an athlete and you've worked long enough to be funded, invested in those pensions, or if you work for a governmental entity, there are a few of you out there that will have pensions available, but most of you won't. Also, again, we've had an expert, like the go-to expert on Social Security, Rick Plum, on our show earlier this year to talk about how solvent Social Security is. But objectively, there are questions looming on how Social Security will perform in the future. So for the majority of you listening in, you can kiss pensions goodbye. Social Security can become questionable. Adequate preparation for retirement requires it's a necessity of having private investment accounts working to accumulate your wealth through direct investment. Yes, in the stock market, but there's a number of ways as well: real estate, private equity, things of that nature. And we've talked about that in previous episodes before. But unlike 401k plans and individual retirement accounts, or what we call qualified investment accounts, private brokerage accounts, taxable accounts, or I actually call them naked accounts because anytime you make a movement, there are tax consequences. Taxable accounts, they don't receive that tax treatment, that favorable tax treatment that qualified accounts have. And so because of that, it's going to require you to have a much more proactive approach to managing your portfolio within those accounts. And it's kind of interesting. According to a new report published by the Qualcomm Group, a consulting and accounting firm, taxpayers with substantial stock holdings have many opportunities to engage in strategic planning to optimize their tax positions, especially during the end of the year, which does not work the same way with qualified accounts. And so with that little precursor, it's time that I finally go into the 8 year-end stock strategies for retirement savers. And again, as I'm going through these, I will be giving the general recommendations, but then my personal take on how well these actually live up. Because just because there is a popular piece of information or recommendation out there, that does not mean that it is the right thing to do. So the first one we're going to go into is taking advantage of the annual loss limit. So in general, with the taxable account, any capital losses in your taxable portfolio must first be used to offset any capital gains. And that is accounting both for short and long-term capital gains. And that actually does not have a dollar limit. So if you have $1 million in capital gains, great. But then you also have $1 million in capital losses, not great. It actually all evens out. So in the eyes of the IRS, there's no tax consequence one way or the other. Now, for those of you who have a total net capital loss and it's more than your capital gain, the excess losses can be applied against your ordinary income up to an annual limit of $3,000 or $3,000, $1,500 if you're married, file separately, or if you're single. And then any remaining losses can be carried forward. And this is a common tool that people use to reduce or possibly reduce their taxable income to potentially lower their tax liability. Now, here's my take on all of this. This is definitely valuable, but this is where I would caution you. Just because you have an investment that has a loss and you have a capital gain of some sort for the year, this does not mean that you have to take the loss. And we're going to talk about this later on in the episode because some of these tips tie into one another. But people often look at the wrong things when it comes to making long-term decisions with short-term thinking. So I'm just going to leave you with that teaser as we go on to number 2. Make a plan to navigate wash sale rules. So for those of you that are not familiar, the wash sale rule is designed to prevent taxpayers from claiming a tax deduction for an investment sold at a loss and then repurchasing it right away. And according to the law, a wash sale rule occurs when a taxpayer sells an asset at a loss and then rebuys it the same or substantially identical security within 30 days before or after the sale. Okay. So basically when you go and sell something at the loss, you got to account for the 30 days before and the 30 days after. Now, if the wash sale is triggered, the loss is not only disallowed for tax purposes, the loss is added to the cost basis of the rebought asset. Not good from a tax standpoint. And so to avoid this, I said it before, I have to repeat it. Make sure repurchases occur outside of that 61-day surrounding window. And it's that a surrounding window surrounding the sale, just to clarify. So, as before, here's my take on that. And it coincides with the first tip that we just went over. Generally speaking, if you can avoid getting into the wash sale predicament, do so. Because too often, people will sell for a loss to plan on repurchasing the asset. But unfortunately, in that period of time, that same asset skyrockets. And when it skyrockets in value, it would have just made sense to not sell in the first place at all. And that happens a lot. So again, there is a value to utilizing the wash sale rule, but you're also kind of gambling because investing is long-term. Planning is long-term. So you just want to be cognizant of that. Number 3, weigh the timing of gains and losses in regards to when they should be recognized. This sounds extremely similar to the first 2 I went over, but there is a slight yet major difference. So you're going to want to evaluate your portfolio to determine not only which investments to possibly sell before year end for what we've already discussed. You should also be thinking about, this is where the difference comes in. You should be thinking about future years in regards to being in a larger or smaller tax bracket in balancing all of that. So for example, if you're going to be in a higher tax bracket in future years, it may make sense to take the gain today in a lower bracket. Because let's say if you sell today, you're in the 15% bracket. Next year, you're in the 27% bracket. 27 minus 15, that's 12%. If you're going to sell it today, you might as well earn 12% on the taxes you won't pay. Awesome. Sounds great. Well, as always, here's my take. I'm all for this. Just to be crystal clear, I am all for this, and you should 100% be talking to your financial planning team, or if you are someone that does this on your own, at the very least, you want to discuss it with your CPA, assuming you have one, because you want to know what would be most optimal. Now, due to compliance in my heavily regulated persona, I cannot say anything specifically due to certain strategies, but I will give you a teaser. My compliance is probably freaking out right now. I'm not going to say too much. Don't worry about it. There are ways to have your cake and eat it too regarding capital gains being greatly diminished or, in some cases, completely avoid it. So let's keep moving to number 4 before my compliance poops their pants. Number 4, consider donating appreciated investments. So if you are charitably inclined, which I hope you are, okay? Because if you are listening to this show, more likely than not, you've either done well for yourself or you are in the process of doing well for yourself, being the motivated individual or people that you are. It's worth giving back. I think it's important to give back because there are people that just aren't as fortunate. That's the way that it is. So be a steward of what you've earned and give to those in need. Don't liquidate 100% of your portfolio and go broke, but there's a balancing act there. So if you are charitably inclined and you expect to have a large estate, or you want to see your money do great work while you're alive, as opposed to just giving it all away after you're gone, donating appreciated investments to a qualified 501c3 nonprofit can be better than selling the asset and then sending the proceeds. And how it works is very, very simple. By donating directly to the charity or charities, you can avoid the capital gain tax on the appreciation and claim a charitable deduction for the fair market value of that asset today. So in order to max out that tax benefit, there is one to-do that you cannot avoid. You will have to have held the asset for more than 1 year. So my take, super advantageous. This is incredibly advantageous. However, just to be really frank, this simply is not going to be applicable for 95% of people out there. So really for this, keep it in your back pocket when you hit that 5% club or 1% club or whatever you want to call it. But other than that, this is more informational for the majority of you. But I can tell you, like for clients in our practice, we do this all the time if it makes sense. So if you have questions on that, obviously you can reach out. And with that, I'm going to take a quick commercial break. And when we come back, we're going to get into step 5 of the 8 year-end stock strategies for retirement savers. So don't go anywhere. Stick around.
Are you ready to transform the way you approach sales? This episode is sponsored by the second book in the Capitalize series, Capitalize Your Sales, the all-in-one sales framework that saves you from ever struggling again and teaches you how to sell with sincerity, which dives deep into the art and science of driving sustainable growth. Packed with strategies that go beyond surface-level techniques, this book will help you understand what it takes to truly connect with clients, build long-term relationships, and close deals. Whether you're looking to fine-tune your sales craft or break through to the next level, Capitalize Your Sales offers a roadmap to success designed for today's fast-paced business world. Head on over to your favorite bookstore, order today, and start capitalizing your sales immediately. And now, back to the episode.
Welcome back from the commercial break. We're going to get right into number 5 on the list, which is think about accelerating income from sources like stock options. So if you work for a tech company or, a company that you have stock options with, this is incredibly pertinent to you. Or if you have friends or family that have stock options and they work for a company like, I don't know, Google or Microsoft, whatever the case is, this is going to be mission critical for them. So if you have unexercised employee stock options, you should consider year-end strategies to optimize your tax situation. I'd say that much is obvious. And here's an example, just to put some context to it. So let's say that you you exercise your non-qualified stock options before year end to accelerate the income recognition. Hold on, say that 10 times fast in this year. You could possibly, as a result of that, take advantage of lower tax rates, and especially if tax rates increase in future years per the IRS or presidential administration preferences. Okay, there's a ton of things that you could look at. Now, if your taxable income is low enough to fall within the 0% long-term capital gain bracket, you could possibly sell appreciated investments, which are stocks through through exercising those options. You could sell those without incurring any capital gain tax, because again, it's at a 0% rate. Now, to give you context for the limits, for 2025, the 0% long-term capital gain rate for individuals in the eyes of the IRS with income under $48,350, tax at zero. If you're married filed jointly, $96,700. And then if you're the head of household, $64,750. Of course, I got to give you my take. Not only is this a gigantic yes, I mean, I do this regularly for clients in our business. And again, taxes should not be the first place to look, which I know that may sound counterintuitive, because I've always said the greatest investment you can guarantee is not an investment, it's the taxes you avoid. That is still true. However, sometimes when you own quality assets, it's okay to forego a little tax, because in the long run, you'll be better off for it. So assuming the criteria is met with everything that I said, you are saving yourself potentially thousands of dollars in taxes every year by utilizing this. So again, big yes. Number 6, think about exercising options in smaller waves. So by doing this over multiple years, you're simply mitigating yourself with a lower tax bracket, which strongly relates back to what we just went over in number 5. In my take, 100% yes. And again, kind of redundant to number 5, but the slight difference is worth mentioning, because with number 5, it's more of a one-off deal. With 6, you're taking that concept and you're stretching it over years. And so if you work for and I'm just going to say tech company, because most tech companies have some form of stock options, and you know what your salary is going to be, you're not on commission, it's pretty steady, plus your stock options. Obviously, you don't know what your stock is going to do in the next 4, 5, 6 years, but there's more assurability and understanding of what you can do. And so you could get really creative and you could pinpoint how to mitigate those taxes to the nth degree over a multitude of years. I mean, I said you could save thousands of dollars. Over the course of 4, 5, 6 years, you could save hundreds of thousands of dollars in tax just by doing this. And this has nothing to do with investment gains. It has everything to do with tax mitigation with the investments that you have. Number 7, make a plan for incentive stock options if you have them. So incentive stock options, by exercising them and holding the stock for more than 1 year, that's going to qualify for long-term capital gains. That being said, and people forget this, if you have incentive stock options, yes, all of that is true, but you have to be mindful of the tax implications regarding alternative minimum taxes. And I'm not going to get too into the weeds of that, because I think that's beyond the scope of this episode. So I want to get straight into my take with this. Because because you're like, man, Chris, you ripped through that pretty quick. Yeah. Incentive stock options are a pretty niche point. Most people have either restricted stock restricted stock units, RSUs, or non-qualified stock options, NQSOs. We welcomed our second baby girl in a month or two ago. And so as of this recording, so still catching up on sleep. So I can give you the best planning ever, but when it comes to abbreviations, dear God, it is a challenge. So I apologize for that. But jokes aside, ISOs are extremely niche. And, most of you simply don't have them. But if you do through your company, this strategy it's an immense game changer. And converting from ordinary income tax to long-term capital gain tax, it is strongly encouraged. I would say, all things being equal, 9 out of 10 times, you're going to want to take that every step of the way. The only time I wouldn't recommend that, I'm kind of going off script here, is let's say that you have a stock. And you know what? I'll use an example without the specific stock. I remember a couple of years ago in one of our portfolios, we, my investment team purchased a company. Yes, we did the diligence, all that fun stuff. And I remember we bought it for, just call it around $10 a share. And there's, reasons, risk reward, all that fun stuff. Well, in 10 months, the stock went from $10 to $100 a share. 10x, not even in a year. And I remember speaking to the team, we were doing analysis and diligence. We decided to sell the whole thing. Now, some clients were not thrilled with that because they were only looking on the tax side of things. But let's face it, if you're up from 10 to 100, you 10 times your money, even if you were in the top percent tax bracket, like tip top. And that gain of $90, let's say half of that was tax. It's not really that case, but let's just say that. Well, net of tax, you took $10 and converted it to 55 in 10 months. Like net of tax return, that is insane. Other than those options or the options, those scenarios, you're going to want to wait to convert ordinary income to capital gains, period. Now, the last one, we're kind of ending on a sad note, okay? Dealing with worthless stock. Obviously not fun. Not a fun conversation at all if you have a stock that is worth zero, because generally you didn't buy it for zero. But if a stock becomes worthless, you can claim a capital loss for the entire cost basis of the stock. So if you bought a stock for, collectively $100,000 and it goes to zero, you get to write the whole thing down. Now, in order to do this, in order to make this happen, the stock has to be completely worthless. And not only completely worthless, there has to be zero potential for recovery. So like bankruptcy, basically. Depending on how long you've held the stock, this can be beneficial for offsetting either long-term capital gains or ordinary income. So here's my take on that. Obviously, okay, we don't want people to be in this position in the first place. But if you are in this unfortunate predicament, the silver lining is the tax benefit to carry forward for future years. If this occurs in a taxable account, it's valuable. It really comes down to the short-term pain of loss that will assist in the long-term gain of eventual gains in either, the rest of your portfolio or income that you can offset with that loss carried forward. So that does it for today's episode on 8 year-end stock strategies for retirement savers and my personal opinion on how valid they are. Obviously, at this point, y'all know where to find me. And with that, I'm going to close this out. As always, I'm your host, Christopher A. Paniotu, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing. Take care. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Chris Frey Panayiotou, Certified Financial Planning Professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. The economic forecast set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. Stock investing includes risks including fluctuating prices and loss of principal. No stock investment strategy or risk management technique can guarantee return or eliminate risk in all market environments. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. The S&P 500 is a stock market index tracking the stock performance of 500 of the largest companies listed on stock exchanges in the United States. Indexes are unmanaged and cannot be invested in directly. Christopher Panayiotou is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Capitalize Your Finances LLC is a separate entity from LPL Financial. Capitalize Your Finances is not registered as a broker-dealer or investment advisor. CRPS conferred by College for Financial Planning.